Good day, good morning to everybody, or afternoon, as the case may be. Today, we're discussing ECRI's U.S. economic growth slowdown call and how we help build conviction with our clients in the run up to such calls. And we'll answer as many questions as we have time for afterward. We're recording this webinar and we'll share the link with all attendees. Some of you have already asked questions. And you can also submit questions by typing them into the Q&A pop-up at the bottom of your screen. Now, during this presentation, we'll also touch upon one of the most important reasons why the way that you monitor cycles in economic growth is central to managing risk. If you're only fixated on recessions, then you're missing a huge opportunity to improve your performance, because the last 30 years saw 10 cyclical slowdowns, and only 3 of them culminated in recession. You can do a lot better by properly understanding and anticipating cycles in economic growth. Because earnings growth is tied to the cycle, slowdowns and accelerations have significant consequences in terms of risk and opportunity for both investors and business managers. Now, in the wake of the last recession, there's been a lot of talk about the need to become more agile, but that's a reactive stance. From our vantage point, it just underscores the importance of anticipating directional changes in economic growth. And it's our unique understanding of cyclical dynamics embedded in our many cycles framework, which allows our clients to proactively navigate key cycles like U.S. economic growth. So our analytical framework includes the active monitoring of many cycles, primarily within the economy's 3 key aspects that are shown here. They're economic cycles, growth cycles and economic growth, that's in green, and then separately inflation cycles in red, and then finally employment shown in blue. Now, our cyclical analysis for clients covers 22 economies, including all the major developed and developing economies. So today's discussion is focused on U.S. domestic economic growth. And the highlighted parts of our framework shown here are what we're going to be really talking about today. So specifically, these are accelerations and decelerations in overall U.S. economic growth. And this cycle is defined by our U.S. Coincident Index shown here, which includes measures of aggregate output, employment, income, and sales. And to be clear, the Coincident Index growth here is the target. It's not a forecast. It's summarizing the hard data on actual economic growth. In this instance, we're showing a smooth growth rate with the orange shaded areas marking off periods of economic deceleration that we call growth rate cycle downturns. And you can see on either end of the slide that there are 2 big recessions that bookend this period: the Great Recession and the COVID recession, with the shaded areas showing the growth rate cycle downturns in between those recessions. Now, these growth rate cycle downturns are important for a number of reasons, and one of them relates to stock prices. This is because our work shows that if you want to manage equity market risk, it's important to understand that major corrections, meaning double-digit percentage declines in S&P, are linked to growth rate cycle downturns in the economy. Now, sure, smaller like 5 or 6 or 7% stock price pullbacks are always possible, but much bigger drops are unlikely unless an economic slowdown arrives. And please note, this is what we've seen in the QE, the so-called QE era following the global financial crisis. Now, before QE, there was a very good correspondence between growth rate cycle downturns and cyclical downturns in stock prices, And those could last several months rather than weeks. And sometimes those ended in outright bear markets. Now, nevertheless, growth rate cycle downturns have become high risk periods where major stock price correction risk is concentrated. And on the flip side, growth rate cycle upturns, the white areas, have been low risk periods devoid of such large corrections. So, to better understand the risk of a correction today, it's helpful to know how we navigated the slowdown and the related market correction that followed the initial rebound from the Great Recession that ended in mid 2009. And so here we're zooming in on that. With our many cycles approach that I touched on earlier, our monitoring of overall economic growth includes a sequential system of indexes that are shown here. And it begins with the long leading index growth shown on the top, which is designed to turn first. Weekly leading and short leading index growth, the second and third lines, are designed to provide confirmation before coincident index growth, the bottom line, finally turns. Now, please recall, it's a while ago, that even after the recession ended in June of 2009, there was intense skepticism about the recovery that extended at least through the late fall of that year. And after that, sentiment flipped and people started pounding the table on a V-shaped recovery. But as you can see, by December of 2009, our analysis had started to foreshadow an upcoming peak in growth. And that stood in stark contrast to the growing optimism about the recovery. So we began preparing our clients for this scenario. Now we're actively monitoring these and other indexes in real time with our clients. And by March of 2010, we knew that the upcoming slowdown was getting close, was getting pretty close. And by late April of 2010, stock prices had started to slip. And in May, we confirmed to our clients who had already been forewarned that the growth rate cycle downturn was indeed getting underway. So now that we've seen what happened the last time there was a slowdown following the initial recovery from a recession, let's look at what's happening this year. Same type of chart, but of course, the current cycle, right at the outset, must recognize it's broken all sorts of records. And so here you see in the early spring of 2021, coming off of the big fiscal packages, including the stimulus checks, the economy was riding high, with the coincident index growth rate at the bottom of the chart hitting nearly 20% growth rate, which is extremely high. So by May, the rising risk of slowing growth became an active feature of our client discussions because that long leading index growth was already clearly signaling that the drivers of the cycle had rolled over. By June, we had clear confirmation that despite the economy really starting to reopen, the slowdown was now baked in the cake. And by July, we confirmed that the actual growth rate cycle downturn was already underway. So you see the point of this sequential development of the process that we have is to be able to have the discussions necessary to help build conviction, because conviction is actually what you need if you're going to go against the crowd. And so today the S&P remains at or near its highs, but many stocks in it are not doing so well. And meanwhile, over in the bond market, we see that it seemed to have priced in the prospect of a cyclical slowdown, and you can see that in the pretty clearly in the real rates. And so that's a quick overview of our growth rate cycle downturn call, how we go about that process, a little bit of how it develops as the turn approaches. And now I'd like to turn to questions that have come in, and there's quite a few of them. We'll get to as many as we can. Question here is, some major consulting firms are saying that the lesson from the supply chain disruptions is that organizations must get more tactically agile in general and more nimble with respect to supply chain management. In particular, do we agree? And I'd say, well, okay, but we have a totally different perspective, a cyclical perspective on this. And we're actually doing it with our clients. Organizational agility can be valuable when there are unexpected disruptions, like a real, true black swan event. And so developing a capability to kind of be agile around that sounds good, probably costs a heck of a lot in an organization. But companies are routinely blindsided by cyclical changes in the direction of growth that are not black swan events, but we often hear business leaders kind of creating a narrative that they work. One that comes to mind, you may remember, is John Chambers at Cisco following the dot-com bust, where he said, hey, the brightest people didn't see this coming. And I and us and my colleagues at ECRI certainly don't claim to be the brightest people, but ECRI saw it coming, and we saw it coming in real time because it was cyclical. Okay, it wasn't a black swan event in that sense. And so this is one way we work with corporate clients. If you have a few months advance notice, you have time to act proactively rather than scrambling to catch up. And even though it is complex, it is actually simpler. I think it's probably a bit superior, and it's, I think, certainly a lower cost solution to the problem of being blindsided by a cyclical turn repeatedly. Another question here is, with WLI growth falling, what does this mean for global industrial growth? So first, just be super clear, the weekly leading index does not inform us about global industrial growth, for which we have different leading indexes. And so the bigger point is that many may not appreciate there cannot be one all-purpose leading index, because different cycles don't generally move in sync. And for what we do with our clients, understanding what the different cycles are doing is key to outperformance versus those who are reducing everything to risk on, risk off. It's more complicated than that. And that's why we developed the framework that we showed earlier. And in that context, the WLI, it is part of a sequence of leading indexes for overall US economic growth. And it's used to build conviction on earlier signals from longer leading indexes on US growth. And here's a shot of that framework again. Another question, how would a COVID peak change your forecast? When would it be reasonably likely that there would be some uptick in activity at the margin between global COVID waves? Would you still purely look at the data to know where we are and treat this as a counter trend short-term move? Okay. So as mentioned, our process around managing cycle risk includes looking at a wide range, monitoring a wide range of our proprietary leading indexes. And that's all part of the framework here. And to the extent that there's a meaningful cyclical impact from events, including the waxing and waning of infections, it'll be captured by the framework. That's what good leading indexes and a good framework do. And so this was a great example of this was just last year. I think when we were all buffeted by these dramatic headlines around the pandemic and politics, and working with our clients, we were able to not get sucked into, or we don't get sucked into whatever dominates the market narrative. And we we stick with what the cyclical view is, and the cyclical view was correctly steadfast, that the upturn call was solid, and that if you go back to that stock market chart, you're in the white area, there's not a lot of risk of serious market corrections. That's what we understood in terms of managing risk at that stage in the cycle last year. Next question, what is your recession outlook? And so, yeah, this question has been coming up more and more. We're not forecasting a recession today. Having said that, to be clear, there's only two ways a growth rate cycle downturn can end, either in a recession or a so-called soft landing. And we're watching this like a hawk on an ongoing basis with all of our forward-looking indicators, and that's the focus of a lot of our discussions privately. Another question, compared to the US, how do the main European and global economic cycles look? Well, first, there is a global slowdown underway. Having said that, there are clear differences among major economies. The European slowdown is actually quite a bit gentler for the time being. And also earlier this year, we drew a critical distinction in our client discussions between the advanced economy slowdowns and the prospects back then for much sharper downturns in emerging market EM growth. And certainly those EM economies also took an additional hit from the global industrial growth downturn that we correctly anticipated. And if you want to know more about that call, the global industrial downturn call, just email Melinda at businesscycle.com, and she can send you a link to a global industrial webinar that we did earlier in the summer that went through all of the pieces of that call. Now, the next question, why are you relatively bearish on US growth, even though the Conference Board and OECD leading indexes are still improving? And so the answer is pretty simple. On the face of it, it's just our analysis. This framework is pointing to a cyclical slowdown, and we have conviction in that call. But, you know, that's still, I guess it's a question many who don't know about us may have, but it's kind of a loaded question. Partly because our research group has been studying cycles, ECRI, in our research group over the past decades, has been studying cycles for much, much longer than anyone else, including those organizations. And cycles have always been our primary focus, unlike those organizations. So our approach, I'm just going to say, is much more sophisticated and in depth. And of course, then you could go the other way and just say, all right, you know, the proof is in the pudding. Most people don't realize that neither of those organizations have ever predicted a recession or a recovery in real time, you know, applied forecasting, whatever their revised data may show today. And then there's another aspect to the question I'd like to address. There are a lot of smart analysts out there. And so in a way, the question could be, why is ECRI more accurate? What's different on the score of cycles? And here, I'd say, you know, look, we have experienced researchers who've spent their lives working on economic cycles, and they are building on a very deep institutional memory going back a century. And so nobody else actually has that. So they're trying to reinvent the wheel on their own. And if you think about it, most everyone who's gone to grad school and done a lot of work on this type of forecasting or looking ahead in the past 40 or 50 years hasn't really learned about economic cycles in depth. And they certainly don't know what we're talking about today. So they're starting from scratch pretty much every time. And they may use words like cycle or words like leading indicator, but their forecasts aren't actually working as well, as reliably. And so many of the institutions that we work with regularly, they have really smart and highly credentialed economists and data scientists, and they add tons of value, right? Those are the people we're working with. And they're answering, part of it, the thing they're doing is answering the what if kind of questions that are based on models that are, of course, backfitted, unlike our work. Our work, totally different. It very much complements that type of work, that in-house work that they're doing, specifically because we're getting the cyclical timing right. That's the component that's being added in. Next question is, leading indicators, your leading indicators have, economic indicators have turned down dramatically. Do you expect them to level off once they get back to normal, quote unquote, normal levels, or do you expect them to turn negative by end of year? So it's another kind of recession question. Our experience working on the US and other major market economies over decades is that neither our leading indexes nor actual economic growth settle down to some sort of equilibrium or normal level during the course of the cycle. There's really much more of a zigzag pattern. And as for what are our leading indicators going to do, what are our leading indexes in this framework going to do in the future, we actually don't try to guess. ECRI's co-founder, Jeffrey Moore, who's been called the father of leading indicators, always told us, don't try to predict the predictors. The next question. So, well, since this, I mean, we're focused on growth, we've got a ton of inflation questions here, too, which is, saying something, I guess, about what people are thinking about. What are the links between the growth rate cycle and the inflation cycle? What risks do you see with the high government debt and spending spree currently underway? And there's a few more like that. So clearly everybody wants to know, or would love to know, what's going to happen to inflation over the next few years. But our research basically shows, the punchline is that may not even have been determined yet. And so we believe the best thing to do is to monitor the evolution of inflation cycle dynamics. And that is what our future inflation gauge, or FIG, is designed to do. And it's a different part of the ECRI framework. It falls in that red area of that slide. And one question is whether the current rise in inflation is going to be transitory, or if we're going to see like a huge run up like we did in the 70s. But if you know that inflation is cyclical, you actually don't have to buy into either viewpoint. And these issues, we really delve into these in great detail in a webinar we did before the global industrial one. We did it back in May. And again, if you email Melinda at businesscycle.com, she'll give you a link to the inflation webinar, and you can see quite a bit of information and charts there. Next question: what is our inflation outlook? Where are we at in the inflation cycle? What's the risk probability of stagflation, given a slowdown in growth and an increase in inflation? Okay, again, the future inflation gauge here is agnostic as to which extreme into those two extreme scenarios. It's just focused like a laser beam on the future, next several quarters, direction of the inflation cycle. And after nailing the upturn, okay, the current inflation cycle upturn, it topped out in the early spring and has eased off a little bit. But because of a number of cross currents, it has yet to pull back decisively. And so you can imagine that this is at the heart of a lot of our private discussions with clients. But that's where we are right now. Next question: who is right, the bond bulls who expect rates to fall, or the rate bulls who expect rates to rise? And again, this was dealt with to a large degree in the inflation webinar that I just mentioned. I would say, and I think I said this during the presentation, that the bond market seems to have clearly priced in the prospect of a cyclical slowdown this one we're talking about today, and the call, that process that we took you with, it's happened over the last several months, and you can see that in real rates. So on a cyclical basis, I think the answer is there. Totally different angle here. This is another question on real estate. Given the vast overpricing of real estate, how soon do you see this bubble being pricked, and how far is the downside? I can't give a date, but based on the rise, I'm expecting a 30% drop. That's not our forecast, that's the questioner's expectation. I would say, look, construction, including residential real estate, that makes up another aspect. Those are cycles that we're tracking in our framework. And on this issue of prices, we do have a leading home price index, and that leading home price index actually nailed the peak in home prices during the last housing boom, and it also really nailed the current housing boom. It had a well-timed and completely clear run-up. Now, for many months, it's been signaling a decline in home price inflation, and we're really actively monitoring things to see when a drop in actual home prices becomes imminent. That's not there at the moment. So we've kind of gone around the world. We've drifted a little bit off of strictly growth, but there seem to be a lot of questions on different aspects of the cycle. We've gone over time. We're going to need to wrap up right now. And if I didn't get to your question, feel free to email Melinda at businesscycle.com. Melinda's going to get a lot of emails now, and let her know what's on your mind, and we will get back to you. Thank you very much for your time today. Thanks.